Hello everyone, this is Phil Yaeger. This is Financial Accounting. And today we're going to go over a multiple choice on diluted earnings per share. Now remember, there's two earnings per share calculations, basic and diluted earnings per share. Now, what is the formula for computing diluted earnings per share? Well, your numerator is net income available to common stockholders divided by the weighted average number of common shares outstanding plus, any potentially diluted securities. Now remember, when you have potentially diluted securities, you assume that everything occurs at the beginning of the year. We'll see that in a second. Weaver Company has 100,000 shares of common stock issued and outstanding at December 31st, 20x8. On July 1st, 20x9, Weaver issued a 10% stock dividend. There's also unexercised stock options, which will be used to purchase 20,000 shares of common stock, adjusted for the 20x9 stock dividends at $20 per share. They were outstanding at the beginning and the end of 20x9. The average market price of Weaver's common stock, which was not affected by the stock dividend, was $25 per share during 20x9. Net income for the year ended December 31st, 20x9 was $550,000. What should Weaver calculate for diluted earnings per share, rounded to the nearest penny, at December 31st, 20x9? That's what they're asking. All right, now we look at the facts here, and on numerator, net income available to common stockholders. Well, the net income for the year is $550,000. Now, there are no preferred dividends paid. Also, we're not adding back any interest net of taxes. That's only if you have convertible bonds. So, the $550,000 is the net income available to the common stockholders. Now, let's get our denominator. The weighted average of number of outstanding shares plus potentially diluted securities. Now, what did they have? Well, Weaver had $100,000 of common stock issued and outstanding at December 31st, 20x9. So, at 11x9, they would have 100,000 shares. Because they had it as of 11x9, they had it for 12 months, so the 100,000 is already weighted. Now, we're going to add to that also, the conversion of the stock options. Assuming the stock options, become stock, they're going to get what? 20,000 additional shares of common stock, at $20 a share. Now, we assume that the stock options were exercised. So what we're going to do here is we're going to add the 20,000 shares as a result of the stock options. And then, don't forget, there was a 10% stock dividend. Now remember, you must assume that the stock dividend occurred on the first day of January 1st, 20x9. So the 100,000 shares will get a 10% stock dividend. That 10,000 is assumed to be outstanding on 1/1/9, so that 10,000 is fully weighted. Now, why do we not weight, the 20,000 shares of common stock? Well, it says here, in parentheses, they were already adjusted for the 20x9 stock dividends. So we just add the 20,000 shares. Now please remember, those 20,000 shares are weighted because the stock options were exercised on January 1st. Now, the next thing we do is this. Under the treasury stock method, for computing diluted earnings per share, we assume this. They exercise the stock options. There are 20,000 of them, and they're exercised at $20 per option. So the total proceeds that the company will get is $400,000. Now, they're going to buy back shares, that's what's called treasury stock. They're going to buy back shares at the average market price, which was $25 per share, which is in the question, So they're going to buy back 16,000 shares of the stock. All right. So what we're going to do here is, all right, we're going to deduct 16,000 shares. So this is what we have. We have 100 shares, 100,000 shares, plus the 10%, 100,000 of the stock dividend of 10,000 shares. We're going to add the shares issued, all right, as a result of the stock options, increasing it by 20,000. And because we bought back 16,000 shares as from treasury stock, all right, this will reduce the outstanding shares. So the total outstanding shares, when you add the 100 plus the 10 plus the 20 minus the shares we bought back with the proceeds from the stock option, we have 114,000 outstanding shares. Now, if we take the $550,000, the net income available to the common stockholders, and we divide by 114,000 outstanding shares, all right, that will give us $4.82, which is the diluted earnings per share. All right, you look for your answer, and the answer is letter A as in apple. All right, this is an example of diluted earnings per share. Thank you, everyone. I hope you understand this concept. I really do. We'll see you again. Take care.